I think even if there was a recession, if they're still fighting inflation, I think the Fed's going to be very reticent to have big rate cuts. And then I think they have to acknowledge that, look, if they do, try to do too much to soften the next economic recession, that inflation could come back faster than they expect. And, that's kind of what we fought in the 70s and 80s is you just kept having higher and higher lows and higher highs in inflation until the Fed finally got real.
Well, certainly the market is treating the recession risk as real. The S&P down 21% this year. The last time the index saw such drop was in the first half of 1970s. That was the first time we saw the first half suffer this much. Let's bring in Taylor Riggs for more. Taylor.
Yeah, Lisa, and really putting that into perspective, and I think what's interesting, Deutsche Bank, I think 2 days ago, had a great note out on this, that this really is one of the more painful starts to a year. We still have about one more week or so until we get to the first half, but so far, barring a huge, massive reversal, this is really going to be one of the worst starts that we've had, particularly when you adjust for inflation. And typically, as we know, stocks have sort of been the bellwether to keep up with inflation. And this time, that really hasn't played out. I think what is interesting, and we always try to be forward-looking on this program, that after some massive declines in the first half, historically, what happens in the second half? Do you get a total washout and you get a little bit of a rebound? Interestingly, you can. After some of these previous years, and we've looked at when the S&P has lost at least 7% or more in the first half. After that, like the 70s, as you can see there, a little bit in 82, and then of course in 2010, after a big washout in 08 and 09, equities have performed pretty well in the second half of the year. I think what is sort of maybe different this time around, though this sounds eerily similar to maybe 2099, is it really has been those big tech stocks, Lisa, right? Because this hasn't really been an equity washout. It has been a refocus on higher yields and what a higher discount rate means for present value. Well, one way we can show this, if you will, and feel free to jump in here, Lisa, is the equal weight's the big outperformer. Growth is the massive underperformer relative to value. That really shows the yield story.
Taylor Riggs, thank you so much. The returns that we've seen, highly negative. Monica DeCenso and Samir Samana both still with us. Monica, how much of margin compressions have we been pricing in, and how much of a downside surprise could we be vulnerable to as the second quarter earnings start trickling out?
I think it's pretty widely viewed that second quarter earnings won't be great. And I think that's reflected to a fair amount in the 20% plus drawdown we've seen. So now the question becomes, how do you think about positioning going into the back half of the year? You saw those stats of how snapbacks have looked in the past. While I don't think this is an 08-like recession, I do want to be cautious that I don't think this will be a COVID-like snapback either. We do think it makes sense to take risk in an appropriate way in pockets where we see possibility for outperformance. Again, thinking about areas in energy and healthcare, maybe even China if we see reopening faster than anticipated. But I just think it's too soon. You still have a few data points coming, Q2 earnings, the Fed kind of digesting more information over the summer before I think you'll start to see the data get easier. Markets are always going to bottom, though, before the data clarifies, so just bear in mind that.
Samir, I'm not trying to get you in trouble, but I've been seeing all of these studies showing that analysts of individual stocks have lagged behind the revisions that we've seen in just price dramatically this year. It's been one of the biggest differentials that we've seen going back to 2000. Do you take anything from some of these analysts' reports as gospel, or do you actually view them more as just sort of a benchmark to understand consensus?
Yeah, I mean, look, consensus is way behind, and earnings are the next shoe to drop. I mean, to your point, look, if revenues are slowing much, much faster than costs are, I mean, margins are probably still, as far as assumptions go, much too high. So we do think that's the next shoe to drop, and we think earnings for probably both 22 and 23 have to come down. And, where those earnings estimates go probably, kind of then leads back to where the market's bottom. Now, I will say, look, in the mid 3,000s, call it around 3,500 or so on the S&P, if we get there, you're getting paid to take the risk with a pretty high level of uncertainty. So at that point, maybe we start to look a little bit through, whether the earnings shoe has dropped or not. But at least here, I think that's the biggest risk to markets is that earnings, at least the biggest, downdrafts from, estimates, assumptions is still to come in the future.
Our thanks to Monica DeCenso, Samir Samana. You're sticking with us. Coming up, recession fears keeping markets on an edge.
In the US case, I think it's quite likely you have a recession. Given the extent of the inflation, the strength of the labor market, the Fed needs to slow the economy, needs to get unemployment up in effect.
And the latest tea leaf is incoming just a few minutes away from another piece of data. That's next from New York. This is Bloomberg. This is Bloomberg Markets, The Open. We do have some data breaking on the terminal. Another downside surprise. Here is our own Michael McKee. Mike.
Yeah, it's the S&P PMIs, the Purchasing Managers Indexes. These are smaller companies than in the ISM report in general, but still representative. And they have all come in weaker than expected, significantly a downturn in manufacturing from 57 to 52.4. The services PMI falls to 51.6 from 53.4. And the composite PMI is 51.2 after 53.6. Now, this parallels what we got from Europe today, which was pretty similar declines. Nobody going into contraction territory, but we are seeing numbers like Germany on their composite falling to 51.3 from 53.7. The French are down. The Eurozone as a whole falls to 51.9 from 54.8. And in the UK, they were the winner of the day. Theirs is unchanged at 53.1. But these are all just barely the numbers that you need to see show expansion. And Lisa, it does suggest that the global economy is cooling. I would go beyond just the manufacturing and look at those services numbers. That's what everybody's going to be keeping an eye on.
Yeah, this was the sector that was supposed to be rebounding as we did reopen. Michael McKee, thank you so much. I do want to just point out that two-year yields take another leg lower, now firmly below 3%, 2.94% we are looking at as we get some of these disappointments. And as Michael said, they do track what we saw over in Europe overnight. 10-year yields sticky. It really is a question of how far the Fed will be willing to go. Back with us, Samir Samana of Wells Fargo Investment Institute, which really goes to the question of whether we're already seeing some sort of downturn in the economy and whether this gives the Fed a reprieve. What's your view, especially given the bid into the front end?
You know, given that the Fed's kind of been cut off sides with this transitory narrative once already, it's going to be hard for them to pivot now back to the economy. So until inflation comes down, I think they're probably a little bit stuck, even if there is a slowdown and even if unemployment does start to tick back up. So, you know, that really is kind of the risk to, you know, kind of the economy and markets that we've been throwing out there, which is, you know, look, if you have a Fed focused on inflation while things are slowing, we just haven't had that combination in a long time. And history tells you that it doesn't end well. So, you know, that's why we are calling for a shallow recession. And, you know, the risk, if anything, is to the downside. And we think, you know, the way for investors to position right now is to move up in quality, move up in market cap, focus on the U.S. We have a little bit of a barbell on the sector side where we like energy, tech, and healthcare. That's because we're still kind of in the latter stages of this, you know, economic, you know, upswing. But eventually, you know, if anything, we'll probably get a little bit more defensive and a little less cyclical. And you know, it's not surprising today that your top 3 or 4 sectors are utilities, healthcare, staples, and REITs. You know, it's a very typical defensive recessionary playbook.
And Morgan Stanley's Mike Wilson with just saying, just with two paths out of this market, quote, the bear market will not be over until recession arrives or the risk of one is extinguished. How much, Samir, are we looking at the dollar remaining the haven bid and remaining the ongoing risk-off trade as we do get this kind of environment without the risk of recession taken off the table yet?
Yeah, I mean, look, the dollar's one of the cleanest trades out there because history tells you that it's almost always a safe haven, during downturns. And this time around, we also have rate differentials working for us as well as growth differentials working for us. So for all those different reasons, if anything, the dollar has, more kind of, boosters this time around than it has during previous downturns. And, kind of to Mike's point, I guess with respect to, until recession, is extinguished, I mean, I would say, it's not over until inflation's extinguished. So, really, again, I think that's the part that we have to think differently about this time around.
So right now, when we see the dollar, it's actually losing a little bit. We are still seeing that bid into bonds. Where are you taking some risk and duration? I say risk because we saw the risk of the first half of the year in terms of what total return was. But where are you taking risk in the safer spheres of the fixed income market?
Sure. So we actually recently took the opportunity to go neutral on long-term duration. We've been most unfavorable for the last year or so as rates, kind of ticked higher. So, that, I think that was a pretty good move. Just again, from the standpoint of bonds do have a role to play in portfolios. And at these yields, it does make sense to be at least neutral. We like higher quality credit. This is not the time to be extending down the credit quality curve. So we recently downgraded high yield. Again, we still think there's time to up the quality in your bond portfolio. We think, from a fixed income standpoint, have mainly been playing kind of defense as opposed to offense, just because you do have rates rising. But we also took the opportunity to raise the rating on short term. Again, with those short term rates rising as quickly as they are, with 75 kind of the new 25, we think some of the income that we had been stretching into the intermediate part of the curve for, we can now get on the short term side. So we up short term, we up long term, we downgraded intermediate just because there's a little bit more opportunity on those tails of the curve.
Samir, can you just put into perspective how defensive you are right now versus, say, 3 months ago, considering that some people are starting to view the next cycle as upcoming and they're starting to invest as such?
Sure. So kind of at a high level, if we were, call it 105 to 110% of our risk budget, as recently as 3 or 4 months ago, we're now probably in the mid-90s. So it's been quite the turn. And again, a lot of it has to do with, I think there were expectations that inflation would at least level off. We were not in the camp that inflation would necessarily come back down quickly, but we at least hope for it to level off. But the fact that it was still accelerating at the last reading, that's really what's changed in the last few months. And, the other thing that's really changed is going from, again, 50 was a real debate. And now that they've moved on to 75 after taking it off the table just months ago, just shows, how much of a tricky spot the Fed's in.
Before we let you go, Samir, how important is tomorrow's University of Michigan sentiment survey?
The sentiment's a lagging indicator, especially consumer sentiment. We can already see that the consumer's stressed, right? I mean, they're taking out loads of debt. Their mix at retailers is all about staples and groceries as opposed to apparel and, retail. So, I mean, again, the consumer's stressed. I wouldn't focus so much on that number. I think the bigger thing is going to be, watch oil, watch commodities. If they can keep coming back down, that'll take some of the pressure off the Fed going into July.
Samir Samana, thank you so much for being with us. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, you are seeing the rally fade just a touch as we head deeper into the open here. We see the S&P now just clawing onto gains up 0.1% after that disappointing number from the PMIs, just following on to what we saw over in Europe. This is Bloomberg. This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrow. That PMI report that was disappointing, really sinking a hole in markets. The Nasdaq turning negative at one point, now up 0.2%. The S&P up 0.3%. If you look over in the bond space, things going pretty wild on the 2-year, sub 2.9% at one point, as yields do continue to drop on the heels of that. 10-year yields now 3.047% if you take it out a bunch of digits, as Tom Keene would like to do. Time now for the trading diary, what you need to be watching this week. week. Chair Powell on Capitol Hill for day 2 of testimony at the top of the hour. The Fed releasing its results from its stress test at 4:30 p.m. The Department of Energy holding a meeting with oil executives today. More Fed speak from Presidents Jim Bullard and Mary Daly on Friday. And finally, new home sales and the University of Michigan Consumer Sentiment Survey to close out the week. This was Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, June 23rd. Here are the top market stories that we're following for you at this hour. PMI pain. You got inflation taking its toll on the U.S. economic activity while combined services and manufacturing in Europe hit a 16-month low and the U.K. runs on empty. We're going to delve into those numbers and prep for 20% more downside. The S&P could fall to 3,000 in a recession. So where do you hide? We're going to speak to the man behind the call, Mike Wilson, Chief U.S. Equity Strategist and CIO at Morgan Stanley. And now it's the House's turn. Fed Chair Jay Powell returns to Congress for his second day of testimony, this time to the House Financial Services Committee. Just how close will the U.S. come to a recession?
From New York, I'm Alex Steele. Guy Johnson is off today. Welcome to Bloomberg Markets. The main story is as we see equities soften up a little bit in a huge move into the bond market are the PMI data. U.S. PMI coming out just moments ago showing falling to 51.6. That's compared to 53.4 last month. And now factory orders and production are in outright contraction. And it's not just the U.S. The numbers in Europe as well as the U.K. were also terrible. The data really rolling over there. We're going to pull up that chart for you in just a second. All economies are dealing with the issue of higher inflation eating into that economic activity. Now it's the severity of that that's really going to matter. So for more, let's bring in the guy behind all those numbers, Chris Williamson, S&P Global Market Intelligence Chief Business Economist. All right, Chris, it's grim anywhere you slice it. So let's just start region by region. The U.S. data is out first. Recently, where is inflation starting to hurt economic growth in the U.S. the most?
It's across the board. Anything non-essential really is being hit. So earlier in the year, we had this nice rebound in the spring where the economy opened up from pandemic restrictions, big boost to consumer spending on services, travel, entertainment, recreation. That's faded. That's even now moving into reverse. As companies are telling us, look, our customers just don't have money in their wallets to spend on this sort of stuff right now. It's the same for non-essential goods as well. Demand there is starting to fall, even worse there, because you've not got that tailwind that's still lingering a bit in the service sector. Now, this is in the US and it's in Europe as well. There's Japanese data, which are lagging a bit because they had Omicron a bit later and are still opening up. So you've still got a bit of a boost there.
Yeah.
But even in Japan, manufacturing is in decline. So across those four largest developed economies of the world, manufacturing is now in decline.
Chris, no doubt manufacturing then getting hurt. Jay Powell talked yesterday to the Senate about how in the U.S. inflation is a demand problem. In Europe, it's a supply problem. And I wondered the distinction then in the PMIs if we're looking at inflation in those two different ways.
To some extent, but everything's going to end up equal, I think, because one of the big things that we noticed here with these surveys in the US and in Europe was that this cooling of demand that you've got is taking pressure off supply chains. So in the US, suppliers' delivery times, which is this key gauge of how long it takes factories to get their supplies delivered, they're lengthening now at the slowest rate since the start of 2021. In Europe, you're now back to late 2020. So the supply chains are easing to most we've seen for about a year and a half. And that's taking pressure off supply chains, which means these suppliers have less pricing power. So you're getting industrial prices starting to come off their peaks. So this is the first in the chain, really. When you get those inflationary pressures coming down, which is demand related across the board, it's not, supply is still a problem, but demand is coming down. So irrespective of what supply is doing, demand is falling, and that's going to take that inflationary pressure off that part of the economy.
Yes, and I want to see what it means for central banks because the bond market definitely moving in that direction. But I wanted to focus in specifically on the supply issue and it relates to Germany. Today we had the German economy minister, Robert Habeck, coming out and saying that we're looking at an alarm phase for Germany's gas risk level. And now there's a conversation about gas rationing. And I can only imagine then what that would do and feed through into factory and manufacturing output. Let's just listen quickly to what he had to say.
We are today now at this moment declaring a gas alert. We have a gas supply disruption in Germany. That is how it is defined. Therefore, it is necessary to declare this alert level. Gas is a scarce commodity in Germany from now on. I say that although or precisely because the security of supply in Germany is currently guaranteed.
So Chris, how much worse could it get then in Europe based on this?
So yeah, energy remains the big problem here in Europe. All other raw material prices, we're going to see some downward pressure on those prices. Energy and food, notably in Europe, are going to remain the problems. And this is what governments are really going to have to try and juggle to keep some energy supply going to sustain these economic upturns. But that undoubtedly is what we're hearing across Europe most. So in Germany, is that their concerns about the outlook are hinging on that energy supply. So this is going to be crucial to the economic performance of the Eurozone economy as a whole as we go through the rest of this year.
Yeah, and if we take a look at, say, the U.S., more of a demand-driven story, Europe supply, I feel like the U.K. is right in the middle, driven by both. You came out in your commentary and said that the U.K. is running on empty. Is the U.K. already in a de facto recession from what the data is telling you?
Yeah, I think it is. So we had growth in the PMI. The index was 53.1. It actually held steady on that reading from May. But when you look at what's driving that, it's orders that have been placed in prior months. There were virtually no new orders across manufacturing and services in June. So what's going to drive growth as we go through the third quarter? Unless demand revives, companies are running out of work to get through. So that's why we're saying that the UK is headed for an even worse patch in the third quarter. And if you look at the official data for the second quarter so far in the UK have been even worse than the PMI. There's some technical reasons behind that, things like government spending on the pandemic being wound down in the second quarter. But, you've got GDP falling in the second quarter probably. Third quarter, PMI suggesting that the economic situation's got worse. So there you're into two quarters of decline, so recession.
Yeah, Chris, last question. I look at the bond market, and what the bond market's telling me is that central banks, whether the BOE, the ECB, or the Fed, are not going to be able to hike the way we thought last week because they're already breaking the economy. What we've seen is already starting to break, and we're looking at recessionary issues. In your assessment, is that what you think is correct?
It certainly looks like it. Look, in those economies, you've already got demand falling. What are interest rates going to do? They're going to dampen demand more. So it's going to exacerbate that downturn. And the thing that you're seeing here, and the thing that we're seeing, say, in those supply chain indices and the price indices, is that the cooling of demand, which is already there, is already doing some of the central bankers' work.
Fair point. Already doing the demand destruction for the central bank. Hey, Chris, it's really good to get the instant reaction from you. Thank you very much. Chris Williamson, S&P Global Chief Business Economist. Thank you very much. So coming up, we got these growing calls of recession, still spooking investors. Recessionary fears, now a bigger deal in the market than inflationary fears. Is it all priced into the market? We're going to break it down with Morgan Stanley Chief U.S. Equity Strategist Mike Wilson next. This is Bloomberg.
Sponsor Bank of America.
if inflation remains elevated, regardless of what we're seeing in terms of GDP, the Fed has said they will continue to raise rates. Right now, the Fed is solely focused on inflation, and if we continue to see elevated prices coming down, particularly from the supply side, the Fed is going to tighten not only into recession, but potentially into a deep and dark recessionary scenario.
That was Stifel Chief Economist Lindsay Piazza joining us on Bloomberg Surveillance, warning of a recession in the near term. So how do you price that into stocks? One of Wall Street's biggest bears says the S&P may need to drop another 15 to 20% to about 3,000 for the market to fully reflect the scale of economic contraction taking place. So with us now is the man behind that call, Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist. Hey, Mike, what kind of recession do we need to see to get to that base case that you have of 3,000?
Yeah, first, that's not our base case. It's our bear case. Our bear case assumes a recession. We're still not quite there yet. And what it really accounts for is a mild recession. It does not account for, a financial crisis or some sort of big accident on the back end of this, because, that's not really how we're set up, meaning, the banking system is very secure. There is a lot of capital still out there, even the corporates. Right, the consumer balance sheet is actually in decent shape. Mm-hmm. So it'll be a mild recession if we get one, and we think the odds are increasing for sure into later this year, next year. And so, we can get through that. And the 3,000 target really does not assume a deep cut. We're assuming about $195, $200 in earnings for next year. That's what a mild recession would bring. And then you take a multiple of about 15 times on that. And that's how you get to those numbers.
But, no, fair point. And I'm sorry about the bear case versus base case. How much percentage now would you give to that bear case if you do see the recession odds end of this year, early next year increasing?
Yeah, so typically, when we do this framework, the bear bull base is usually sort of 60% base, 20% on the tails. And no doubt that the downside case is increased in probability. It's probably something like 50% for the bear case now, probably 50% for the base case, I apologize, 35% for the bear, and 15 on the bull. And the bull really is getting pretty unlikely. The bull case is sort of this Goldilocks outcome. Seems unlikely, but, we'll adjust our targets, and that's what we do. It's probability adjusted. The reason we wrote the note this week, Alex, is because, as you've been saying in this segment, that's the number one question we've been getting from clients. So we just wanted to put a framework around it for them, how to think about it so they can, invest appropriately. Because, look, we've done a lot of price damage, right? We want to be investing into the price damage, but we think it's premature if the risk of recession is still increasing. So therefore, as you move further away from, say, 3,500, which we are now, 3,800 is kind of where we are today, the risk reward is pretty poor, and that's really the bottom line conclusion. We're trying to kind of thread a needle here, and we're never going to call the bottom exactly. What we're trying to do is put risk-reward framework around it for clients so that they can take the proper action at the right time.
Well, what's so interesting to me is the ferocious move in the bond market. In many ways, sort of the selling pressure in the bond market and higher yields had already happened in the last couple of weeks. I mean, just today we get this terrible PMI number out of Europe and the UK and the US, and we see an enormous rally in the bond market. Yields really lower. 3-year yield now 20 basis points lower. And I wonder what you think the reaction function is going to be from the bond market to the equity market when we seem to be front-running a lot of this.
This has been one of the things we've actually underestimated this year. We started buying bonds in our asset allocation back in April, thinking the worst was kind of behind us, that, the bond market had already priced in the recovery as far as it was going to go, and we underestimated how far 10-year could go. So in some ways we saw an overshoot. This is kind of resetting back towards 3% on a 10-year, which I would say kind of reflects more of our fundamental outlook, quite frankly, and on our general view that the Fed has probably already done enough to slow the economy enough to kind of achieve their goals. Either we're going to get a soft landing or we're going to get a recession. It's one of the two. But, I mean, look, mortgage rates at 6% is kind of all you need to know to suggest that the Fed's already gone far enough to slow the economy in a meaningful way.
So does that mean, base case, you guys don't expect more rate hikes, or just not the kind of 75 bips that the rest of the market is expecting?
No, I want to make it perfectly clear. I mean, we expect the Fed to go forward on its path. We don't think they're bluffing on that. Okay. However, I would strongly suggest that the market is pricing in the continuation of that lasting longer than what reality is going to be. In other words, I'm skeptical as to whether the terminal rate is really going to be 350 or 4%. I think it's going to be well below that.
Okay, fair point. So then let's get to the equity allocation in this. So how do you make money then in this environment? A, how do you protect yourself? And then what do you buy on a discount?
Yeah, so we've been positioned defensively all year, as you noted. I mean, we've been probably more bearish than most. It's worked quite well. There's two things that have been working this year: defensively oriented stocks and energy. We've been more neutral in energy because of what's happening now, right? Energy eventually is going to figure out that growth is slowing too, and actually the crude market does not look particularly good to me on a technical basis. So I think energy looks a little bit dangerous now, and we're going to fare back into those defensive areas. And quite frankly, we may see a bid back into some of the high quality, longer duration growth stocks if rates come down here. Okay. Because recession is not inevitable yet, so we may see people come back into trying to buy these, higher quality, large cap tech names if rates are coming down in the absence of evidence that a recession is imminent. That we think that would be a counter trend trade, but that could work in the short term. And then the real factor that's working, Alex, is operational efficiency. What the market's paying for right now is companies that can deliver on cash flow and earnings in this difficult environment, and so that's a factor that we've been tracking closely, and it's working quite well.
Yeah, Mike, let's dig into that, because you guys did a screen for that, because the rhetoric is that we're going to have to see earnings downgrades because of margins. Like sales can hold up, for example, but the margin pressure is just too great, and then you're going to see the downgrades. What does have that pricing power, I should say?
It's not even about pricing power so much. It's more about who can just get the sales in the door and then to the bottom line efficiently. So the companies that screen well are ones that have low inventory to sales growth, low capex to sales, and then low employee costs as a percentage of cost of goods sold. I can't name names specifically here, but basically it's not quite a quality screen. Once again, it's more about companies that are being very judicious with the revenues that are coming in the door and doing a good job of managing the business. And so that can be companies within the same sector. Quite frankly, there's better operators, and those are the ones that are working right now.
And last question, Mike. As you look at the market and the tumultuous few months that we've had, where are we already pricing in your base case? Like, where have equities been hit hard enough?
Yeah, I mean, that's what we're trying to figure out now. I mean, we've been most bearish on consumer goods, consumer cyclicals, some of the technology complex, because that's where the over-earning was the greatest. But let's be honest, I mean, those stocks have come down quite a bit. So I don't think you can make a wholesale call yet on either sector, but there's absolutely names within those buckets where we're looking for are stocks that have not only seen a price degradation, but have also seen the earnings come down. We want to see both. And I think the third factor is they've got to be profitable. Right? We don't think we're going to go back to this environment for any time soon. Even if we avoid a recession, or even if we have a recession and recovery, we think this era of paying up for kind of profitless growth, that's a trend that's not going to come back in favor. And unfortunately, there are a lot of those types of companies in the technology space. So you got to be really careful with that. I would say, one area that looks, getting close, like home builders, are trading with very low multiples. If rates are going to start peaking out here, you want to be buying home builders into a recession if it comes. So maybe it's a little bit premature, but some of those things are looking kind of interesting to us just on valuation alone and the damage that's already been done.
Hey, Mike, really appreciate it. Great to get your perspective today. You got the S&P up by about 0.4%. Mike Wilson at Morgan Stanley, good to see you. So still ahead, we were going to bring you some live comments from Federal Reserve Chair Jay Powell as he testifies before the House Financial Services Committee. He's reading his opening statements now. We will bring you that Q&A in just a few minutes. This is Bloomberg.
We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. We will make
This is Bloomberg.
We need to make sure that we have enough oil and gas in the economy now over the next several years to meet the demand that we have in the economy. We know we have the demand, so I think that we'd like to work together with the industry. Tell us what you need, and tell us how you plan to use your record profits investing back into the industry, into production, into refining, so that Americans can pay a little bit less at the pump.
That was Presidential Coordinator for Energy Security, Amos Hochstein, earlier on Bloomberg Surveillance, calling for energy producers to increase output and to help the consumer. And later on today, you got oil executives are going to be meeting with Energy Secretary Jennifer Granholm, particularly refiners, to discuss what more can be done. For more, let's bring in Joe Matthew, host of Sound On Bloomberg Radio. Joe, the two things that would actually really help is reducing the ethanol biofuel mandates for refiners and waiving the Jones Act, which means you have to ship on a U.S. ship if you're going from place to place in the U.S. Are those things even on the table?
It's a great question. We don't have a lot of insight into what exactly is going to be discussed in this meeting. We know that the 7 major refiners are going to be at the White House. We also know that President Biden is not going to be in the room. So while the White House is asking for help in increasing production here, the oil companies are going to be asking for help as well, along the lines of maybe what you're talking about, also more access to pipelines and kind of greasing the skids for permitting. I don't know that the White House is prepared to green light some of these questions, though, so it's unclear exactly what we're going to end up with today.
Yep, exactly the point. All right, Joe, thanks a lot. I appreciate it. Joe Matthew, host of Sound On Bloomberg Radio. And no doubt that corporate greed scenario was front and center yesterday in the Senate, and it could be front and center today in the House. Let's go to Fed Chair Jay Powell, who's speaking before the House Financial Services Committee, answering a question from Chairwoman Maxine Waters.
In situations where supply is constrained and demand is very strong. And so take cars, for example. The demand for cars went up a great deal. During the pandemic, people wanted to ride in cars rather than public transportation, and they wanted to move to the suburbs and things like that. Rates were low. The economy was stronger than people expected. But the companies couldn't really make more cars because they couldn't raise their output because of the lack of semiconductors. So when demand hits fixed supply, what happens is prices go up and margins went up. And so I think as the economy returns to normal, we would expect those profit margins to return to more normal levels.
Well, Chairman Powell, the example that I gave of Tyson, who said their prices were rising because of labor and freight costs, and yet they managed to net an additional $500 million quarterly profits.
I apologize. I'm having a hard time hearing your words. I'm sorry.
Okay. The example that I gave of Tyson Foods and the fact that they said that their prices were rising due to labor and freight costs, yet they managed to net an additional $500 million in quarterly profits. How do you explain that?
I'm not familiar with their profit and loss statement, but I will say, and again, there may be particular industries where there are competition issues. I don't know that. It's really not our focus or our authority.
Well, do you have the opportunity to look at rising costs and identify corporations where they are gaining substantial profits, yet they keep raising their prices? Do you have a way of examining that?
I think we can see that, but I think, you know, our job is to keep, maximum employment and price stability. So we're not in the business of regulating individual companies or determining whether their actions, for example, are anti-competitive or that sort of thing. That's more for elected people and also for the competition authorities. So we do look at that. But again, I think a great deal of the price increases that you saw were a matter of supply being unable to meet demand, and the result was prices moving up. In many cases, that was the story.
Thank you very much. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Thank you, Madam Chair. I would, on this debate about corporate profits, I would commend to the committee Secretary Yellen's statement where she rejects the idea of corporate greed is to blame for inflation. And I concur. We have we have a complex set of issues. The fiscal house was certainly different than monetary policy. And the extraordinary nature of the partisan American Rescue Plan, and the $2 trillion injected into a recovering economy, and Democrat policies to keep people out of the workforce for longer than the rest of the Western world also contributed to inflation. So that is a political debate here on Capitol Hill, Chairman Powell, and that is on the political side. What I want to ask you about are the policy tools that you are using. Now, certainly, you, as chair of the Fed and the Open Markets Committee, took extraordinary measures in the midst of the pandemic to ensure that we didn't have further contagion, and including extraordinary lending facilities, purchasing securities, keeping the funds, federal funds rate at zero. These were the right tools at the right time. On the fiscal side, you had to partner with bipartisan bills to keep our economy afloat during the government shutdowns. But like all the good firefighting measures, we should put them away when times change. I want to talk to you as you put these measures away, how you expect the economy to respond. So let's start here. What is your level of commitment to fight inflation?
Well, so it's unconditional, our commitment is, and the reason is that we need to, in a particular situation, we have a labor market that's sort of unsustainably hot, and we're very far from our inflation target. We really need to restore price stability, get inflation back down to 2%, because without that, we're not going to be able to have a sustained period of maximum employment where the benefits are spread very widely and where people's wages aren't being eaten up by inflation. Really, it's something that we need to do, we must do, in order to have that kind of a labor market. We'll need to do it.
So as you pull back these emergency measures from COVID and you normalize rates to what they look like sort of in the long run, how do you expect the economy to respond?
So when we raise interest rates and also to a lesser extent when the balance sheet shrinks, what happens is rates go up across the economy and financial conditions generally tighten. And you can think of it as in interest-sensitive spending is an important place that'll be affected, and that's things like automobiles and other durable goods. If rates are higher, then demand for cars will moderate, will decline a bit. The second channel would be asset prices generally. We don't target any particular asset prices, but higher interest rates tend to bring them down broadly. That tends to mean a little bit less spending. Out of because people's wealth has perhaps declined a little bit. And the third channel can be the exchange rate, where that also has disinflation effects. So overall, we have these effects on the economy. Our intent, of course, is to bring inflation down to 2% while preserving a strong labor market. As I've mentioned, that has become significantly more challenging with the events of the past few months, particularly the war, which is driving gas prices up and raising energy prices and also food prices and disrupting supply chains further.
So at the same time, you have a massive balance sheet. First begin with mortgage-backed securities. As we have a roll-off of the Fed's balance sheet of mortgage-backed securities, what are expectations for how that affects housing?
So I think what will affect housing is the rate. The housing industry and market are slowing down from a very, very hot pace, and that's partially because of higher mortgage rates. The effects of shrinking the balance sheet will be marginal compared to the effects that we're seeing and expect to continue to see from rates rising mortgage rates.
But what are your expectations and any further announcements? Can we expect further announcements on the assets you hold and the securities you hold? Or are there going to be balance sheet announcements in the coming weeks?
No, I would say this. We have a plan. We've articulated it. The markets are forward-looking. They see it. And the markets are in a good place, I think, understanding what we're going to do. And we're going to be allowing these securities to mature and run off our balance sheet at a pace that we've said. And it'll be 90 or 95 billion, I guess, by September. Now it's about half of that. So that's what we've done, and we expect, the idea is that that'll just be on an ongoing basis in the background, and we think the markets can handle that, Treasury issuance is way down, so we think there will be demand for these securities. The Treasury will then reissue them in whatever form they think is appropriate when it relates to Treasuries. So,
thank you.
The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chair, it's good to see you, and I know you'll hear a lot of probably political stuff going back and forth, but the American public is trying to understand the language of which we're talking today so that we can really understand what inflation is. Fact of the matter is, I just recently was over in Europe. There's inflation in Europe, just like there's inflation here. Although, as I talked to Christine Lagarde and others, they say the cause of the inflation may be different. So at the